Good morning, ladies and gentlemen. Well, I don't think there's any more doubt that we are in risk off. The risk dial keeps on getting worse with every small decline, and I think that it's going to take a long time before we go back to risk on. What I really want to do is examine the reasons behind that and what we can expect in quarter two. This is real rates, and we are basically stuck at 2%. Now, I've been saying for weeks that I think that real rates will remain high. The budget deficits are just not going to go down worldwide. I think they're more likely to go up than down. Even in the US, I think the likelihood of Doge being able to make huge cuts which are not then reversed by some judicial decision, i.e., cuts that stick, is not very high. Simply because even if we don't go into recession and we have real growth, which is much lower than we anticipated earlier in the year or late last year, let's say that we have real growth at 0.5% or something like that, that is actually going to reduce the tax take through corporation taxes and other taxes, because I think that if these tariffs stick, and we will know next week what he plans to introduce, but I think they are likely to reduce the profitability of companies, and therefore there will be less tax take overall, even if Doge does some good. And that is going to tend to keep real rates high. While real rates are high and profitability of companies goes down, I think that continues risk off for quite some time. And I think what is interesting is to see how the markets have performed the last quarter, because that is probably an indication about how they're going to continue to perform. So this is a table of the performance of various ETFs in bonds and equities and commodities. And really, I know that we haven't ended Q1 yet, that's on Monday, but what's the difference? So these are the closing prices on Friday. And what I notice is that the TIPS sector, this is the TIP ETF and this is TIPZ, which is the longest TIP that you can buy, the longest maturities, are really keeping pace with all the others. Okay, now this is for an unlevered portfolio. So if you just buy $1 for $1 of SHI or TLT, I know that the risk isn't the same, but it gives you an indication that people are buying TIPS. They're buying inflation protected assets. It's very, very unusual for TIPS to perform the same as TLT, right? So what that tells me is that people are very dubious and doubt very much that inflation can be reduced very quickly, i.e. the market is saying that inflation is going to remain sticky. And if inflation remains sticky and also you get lower growth, that really favors the tip sector as opposed to the nominal bond sector. And given the fact that if that is the case, with the lower growth, you get lower profitability and you get equities going down in the US. Now, as you can see, it's a US problem. It's not a worldwide problem. ACWX, which is, the stock markets without the US, had a wonderful quarter, 7%. Great quarter. I don't think it's going to keep on going like this in terms of divergences, but it just basically tells you that people are avoiding the US, they're avoiding high beta, They don't think the bonds are really going to help the high beta, which they normally do, and they're sticking to real rates because they think that real rates are going to remain high. And they also tell you that they don't have a huge amount of confidence because gold is up 17% and EBIT, which is, the Bitcoin, is down 10%. So EBIT is the worst performer, gold is the best performer, and really if you want to be really careful and shepherd your money, you're in TIP or TIPZ. And that tells me that this market is really, really scared of what is going to happen during Q2. Now, the other thing that I agree with other people is that if I were a company CFO, I would put in all the bad news that I possibly can into the next earnings set, because this is a wonderful opportunity for them to do that. And then they can beat. But when can they beat? They can beat in Q3. So I think the next quarter is a continuation of these trends, and then Q3 can find some relief. But for the time being, I just don't see that this is going to get much better. In fact, I think it's going to get worse, because if you have continuing high real rates, wherever nominals go, so if real rates are high, these numbers cannot really start going up unless the economy starts accelerating again, and I think that that is low odds. So last week we had the auctions. They went reasonably well, and what did the market do? It was stuck in a very, very narrow range, and as soon as equities started giving up on Friday, you got the money flowing into twos. It's quite obvious that money is flowing into the short end, even though we are trading in the twos, well, a good 25, 30 basis points below the general collateral and below Fed funds. Why are they doing this? Well, obviously out of fear. Now, I think that what the market is pricing is probably one of the least likely outcomes for the rest of the year. The market is pricing close to 3 cuts from the Fed. Their dot plots, which mean nothing, as I told you last week, are pricing in 2. I think it's either going to be 0 or it's going to be 6 plus, because either we avoid recession, in which case I think the inflation rate stays sticky around 2.5 and the Fed is on indefinite hold, or we do tip into recession, of which there is absolutely zero evidence in the data, and in that case the Fed cuts like crazy, cuts to 2.5, something like that. So this to me is the least likely outcome, and the way the yield curve is trading tells you that basically it's just money coming out of equities and going into the very short end. You have, they put something in 3-month bills, but 3-month bills go nowhere because they're on top of Fed funds, right? So there's absolutely nothing to be done there. And so they put it into short duration bonds, something like 2 years. And the way the 2-year, 10-year is trading basically tells you that. 10 years are doing nothing, 30 years are doing nothing. I mean, 30 years are actually a couple of basis points higher in yield than they were this time last week. So the 30-year is absolutely stuck. If people really believe that we're going to have recession, they would be buying everything. I mean, they would definitely be buying 30 years, they'll be buying 10 years, they'll be buying the long end of the curve because they get more bang for their buck. Here, they're telling you that they have absolutely no idea what is going on, but to be careful, they're taking money out of equities and putting it into the place they're going to lose the least money, i.e. anything up to 2 years in on the bond curve. What are you going to lose if you even buy twos at 390. At worst, they mature and that's it. You just leave the money there, and even if you need to take it out and put it back into equities later on, if you lose 10, 15, 20 basis points on a 2 year, that in terms of percentages, that is nothing compared to what you could lose on the equity side. So they're quite happy. What am I telling you in the bonds? That nothing much is happening in the bonds. Real rates are staying high though. You can tell that no one is convinced that we're having a recession. Otherwise, they'd be buying the shit out of this, and they're not. Now, 10 years, they're giving Besson the benefit of the doubt. I don't think that the long end is going to go anywhere for quite some time. 2s 30s and 5s 30s, and this is 5s 30s, are telling you that story, that people are putting money into the shorter end of the bond market. They like anything short to middle, and that is the story. I think it's going to be very, very hard indeed for this market, for the 5s 30s, to break through this kind of level at minus 67. You can see how important it is. And if it does, it's going to become a signal that people are really beginning to look for a much weaker environment in the US. It's, how shall I put it? I really don't see that people will continue buying the short end so much below Fed funds unless they start expecting cuts very quickly. Why would they expect cuts very quickly? Well, they would only expect them because the economy is showing signs of weakness, i.e. weak data comes out. This is front-running the weak data. If we can bust through these levels, then really we're expecting weak data, but we're also expecting or seeing weak data, but we're also seeing weak data with an inflation rate which is not really moderating. And that really does steepen the curve, because the long end is much more susceptible to inflation, the short end is much more susceptible to growth, and what the Fed does, and the Fed would act if growth goes down, because the likelihood of inflation accelerating if growth goes down is very low. On the other hand, is it going to come down with Fed cuts? That's what the long end would be worried about, and that's why you get the steepening. So 2s 30s and 5s 30s are going in the same direction, but they're getting to a level which was very, very important and very tough to go through in previous periods. Minus 81 in the 2s 30s, and then in the 5s 30s, here we are, minus 67. It tends to stay here for a long time until data confirms, and then you start going down quite quickly, because that is when the data confirms the weakness of the economy. So will NFP next week be the first data dot that we get that confirms it? Who knows? I think it's probably too early, but it's certainly one of the possibilities. And the yield curve will keep on steepening until there is a confirmation that the economy is not going into recession. So that is your trend. Every time there's a bounce, you keep on selling it, because it's just the trend until we have absolute certainty that we're not going to go into recession. In Europe, the Schatz has returned to exactly where it was before the announcement of the German fiscal reflation, and that is probably as it should be, because are we going to get higher inflation in Germany? Who knows? Are we going to get the ECB to tighten? Definitely not. What is going to happen is that real rates will remain higher for longer, which is my thesis for quite some time. and that means steepening. So tariffs on cars and whatever is announced next week by Trump, which we're all expecting that him to announce quite a bit of tariffs on the EU, will keep the EU economy weaker, and therefore the two-year note is not something that you want to short. And especially if all the stock market's correct as well, people will continue piling into the shats and avoiding the longer end. So you get two tens continuing to do this, and would it be really surprising if two tens by at some stage touched -88? I don't think so. I think it's it's a continuation of a trend. Now, what about the Bund? I still think that the Bund can reach these kinds of levels around the 262 to 65 level and then go again. I showed you those monthly charts. I think it's going to take probably several months for the Bund to start going up again and reaching 365. I am convinced that the Bund will go higher, but in the meantime, I think you don't want to short the Bund by itself until you see this kind of level. Now, what you can do is you can short it on the spread against the shats, you can short it against all sorts of other things like even the US, but by itself you don't want to short it until you've seen the 260, 265 area. In terms of spread between the tens and the bunds, I still haven't changed my mind. I would love to see this gap fill up to 167 and then down. I'm absolutely convinced that eventually we go down to this level 123, and I will continue to play it that way. When I see that we are at the top of the Bollingers, anywhere near 172, I think the risk reward is back to the downside. We are just faffing around, and basically what that says is not yet. I will wait, I will be patient. I'd rather miss it than sort of get in at a very bad level. And this is like no man's land right here. So I'm going to be patient and wait. We might get an ABC kind of thing in a few weeks. Data will tell me when to do it. I'm going to be patient here. I still think that though over time the direction is down towards 105 and 125 first. Things have not changed, right? It's just the pricing that's slightly changed because we were so oversold down here. So Germany will reflate fiscally and probably a hell of a lot, and the US will attempt to deflate fiscally. And that is what the whole fear in the stock market is, the fiscal deflation in the US. So it either happens or it doesn't. I think the odds are that probably does, but it keeps real rates high because it's going to be slow and it's not going to be as huge as people might expect. If you look at this chart of DXY, it's basically identical to the charts of tens differentials that I just showed you. It got very close to the level that I wanted to sell, 105, and really the weekly is telling you that the pressure is going to continue to the downside, but it's not going to go outside of the range, and therefore I think that tens are going to remain 140, 165, what you want to do, and it's going to just trade around in the same levels as last week with probably a little bit more pressure before up. Does that tell me anything about what the tariffs are going to be? No, not really, but I think the market has probably front run the tariffs quite successfully now, and it might be a case of that we see 105 again once the news hits, but that to me is a sell, because at some stage we go down to 103 and then back down to 101. That is the same view that I have for the differential in tens, i.e. that differential goes down towards 125 and 105 eventually, and the dollar goes down towards parity. This is dollar yen, and every time it gets towards 151.65, you are supposed to sell it. You can see the 200-day moving average coming down, the 50-day moving average as well. We've got a death cross. This, to me, is a sign that we are more likely to trade down, and that is also a sign of continuing risk off. So euro yen as well is probably going to do very little, and this is euro yen. I can't see it busting through the 164 area. I think that is its highs for the time being, and can I see it a little bit more down towards 157, 158 again? Yes, and that is all a sign of risk off. Gold just doesn't care, does it? It's through the monthly Bollingers as well, which is never really a good sign because it comes back. But here we are, 373 the monthly Bollingers are, and we are 1% above it. At some stage it's going to come back and test levels, but this is, in trend, and it just keeps on going up. That also tells you that, how low can inflation get as a result? Are we breaking the back of inflation? Obviously the market is saying no. The interesting one is, to me, the spreads against gold of various assets like tips and commodities, which are beginning to absolutely make no sense at all. This is gold against tip, and it keeps on going. I just can't understand this. I really cannot. I can't understand what the market is telling me, because tips are doing perfectly all right. I understand what the market is saying in tips. I can't understand why the market is so much preferring gold to tips. It could be something to do with just the Chinese demand, and it's no more than that. But what about, gold against GSG? It's, I liked it here. I'm not really so sure up here. And GSG is doing absolutely nothing. But I'm getting more and more bullish of GSG. I think the odds are higher that it starts breaking upwards than it starts breaking downwards. I think that 2170 is going to be very difficult to break to the downside, and it keeps on returning. The more it coils here, the more the move is going to be explosive if it starts breaking through this 2293. And if you have one weekly close or two weekly closes above 2293, you really have to start saying that it's going to go and test these levels here. And don't forget that we are still a lot lower than we were back in 2011 even. You're looking for a move to this kind of level, 33, 34. That is a big move. And that is what gold could be saying. Gold could be saying that inflation is going to be quite high, in which case it could make sense that it's trading where it's trading. But I would much prefer to be a buyer of commodities on a dip than a buyer of gold at these levels. I think that this is perfectly possible. SPX is trading technically very well indeed, and if I just enlarge this area, you can see that we got to the first level that I thought was really important, the 57.62. I was hoping for 58.64 rather. Never got it, and then the market just broke. And it just keeps on going from one level to the other. 56, 68, 69 is your swing level, while below it's weak, while above it's only going to touch at best 58.64 before it goes back down. I think that the market is now deciding that it wants to go down some more. I know that ahead of the announcement on Wednesday, it's probably going to fuff around in both directions and just fill this gap and then come back. But eventually, I think this market has decided that it wants to do at least an ABC, so at least, down to these levels. And I think the real natural support is not until the 5200s, and I'll show you why. So this is a daily chart. This is the low that we had in November of 2023, where we started buying equities hand over fist. And this is the 0.382 retracement at 53.65, and then the 50% retracement at 51.23. Measured moves would give you this kind of a move, but I think the real support is at this level, where we hesitated for quite a long time. And if we actually look at then weekly and monthly, I think the monthly chart here is important, and 52.54 to me is going to be very, very important, because that is where we had 3 months of hesitation before we started going higher again, and that's where the support from the moving averages comes in for next month as well. So around the 52.54 area is where I would expect it to go. Now on the weeklies, we closed through the Bollinger Band again. I don't think that that can last. Can we go down a little bit? Yes, and come back. I think that is the way the market will trade. It's very, very unlikely that markets continue much below the Bollinger Band. And you can see where the real support is going to be in 2 or 3, 4 weeks' time. Continuing here, it's going to be in the 5200s. To me, those are the really, really important level in the 5200s. Until you get into the 5200s, I think you can short every rally. After that, I really think that the risk reward is no longer there. Even on the 195-minute chart, as you can see, 56.69. If it gets up there, you're supposed to be buying put spreads. There's just not a lot, more to be said. Can it go a little bit further? Maybe. But it's, to me, I have zero doubt that we are going to go and fill these gaps and go down into the 5200s at some stage. The market seems to have decided that it's heavy, that and this is really key to me, that the earnings that they will project for Q2 are going to be markedly lower. So if you get the long bonds really not doing anything, i.e. not helping with the multiplier, why not re-rate equities a couple of points lower, i.e. instead of using X22, use X20, X19, and that takes you down quite a bit. So I think that is lower multiplier, lower earnings, because companies throw the kitchen sink at their balance sheet and make sure that they beat in Q3. That all gives us at least the 5200s. NDX, much the same story. What kind of levels does it show? 18,350 minimum, absolutely minimum. And really you are possibly looking at these kinds of lows around the 17,300, and that gives us exactly just below the 0.382 where the really, really big support is going to be. It's going to take several weeks, but I think the pathway is this, and really it coincides with the SPX. I would have thought this kind of area is minimum, and you can see where the really, really big support is, 16,560. I don't think we can go through there, but I think over time we can jab into these lower levels, and this is where the risk reward areas are, between 0.382 and zero point 0.5, as close to 16,600 as possible, and there you buy calls, long term calls. Even the foreign markets on Friday gave up, and they show you the direction of equities overall. Now, my view is quite simple. I think that developed market bonds, i.e. European bonds and JGBs and so on, will perform worse than US bonds. And I think that equities in the US will continue to perform worse on spread than equities in the rest of the world, for the very simple macro reasons that I gave you at the beginning of the video. So bonds spreads come in, equity spreads continue going out. But while the foreign markets are weak, and I really don't think that there's any need to be buying Nikkei until he gets to this kind of level, 34,000, 33,500, that tells me that the overall direction of the equity markets is down. It just means that the US will go down more in percentage terms. It just doesn't mean anything else. I think the Nikkei around this kind of area, around 33,000 to 33,000 and a half, is the equivalent level of where you really want to buy it for another move higher. What is happening in the, you can see this is now Europe, the stocks, the fact that they've broken down below their previous low tells me that the US will break down before, below. But also it tells me that the equivalent level that you want to buy in the stocks is down here, just over 51,000. So here we have about 200 points, which is around 4%. So if this comes down 4% and the US comes down 6-7%, there you have the idea of where you could easily find yourself over the course of the next month or so. I think there's very little doubt the volatility is beginning to rise, and that is also a sign of risk off. We got right down to the 200-day moving average, and we bounced in 3 days, undid the work of 2 weeks. I think it's low likelihood that Monday or Tuesday we break 2280. But if we remain in this range and don't start coming down a lot, there's one more leg straight back up to this 2830 area. 3011 on a weekly is extremely important, and if we were to start busting through there, it's a disaster. But that is why I think that the equity markets are going to remain under pressure in the medium term, because I think that we have another leg higher in volatility and that we will see the 30s at some stage, and that should mark the low in equities. But I think that low is quite a few percentage points away yet. We will see what Trump has in store for us on Wednesday, but I think that whatever he has in store for us is not going to change the overall picture. There might be volatility, that might be sort of buy the rumor, sell the news kind of thing, but overall it's going to be a continuation of risk off. We're still not at levels that make any sense because, as I told you, I think real rates are going to remain high. Therefore, yield curves are more likely to steepen than not, simply because people are taking money out of equities and putting them into the safest part of the curve, i.e. the very short end. And if the tips keep on appreciating at the same level as nominals, and if gold keeps on going up, they're all telling you the same thing. People think inflation is going to remain pretty high and sticky, and We will see if that leads to recession or not, but if it were to, you will get the biggest bang for your buck in the tips, I think. So it is what it is. We need to wait until the data confirms what the growth rate is. It might not be NFP either, but the path of least resistance is one of people de-risking, continuing de-risking into news. And let's even think about NFP. What happens if NFP is strong, i.e., sort of in line to strong? Well, people are just going to say, well, there you are. It's not yet. The bad news is going to come later on, i.e., in another month or 2 months or whatever. So the market might breathe a sigh of relief, equities might rally 1%, but what happens if it's really, really weak or negative? There's no reason for it because weekly claims have been perfectly in line, therefore it's low odds that that happens. But if it were to happen, you would get an absolute disaster in the stock market and everybody would be buying bonds with both hands. So the risk reward is to wait for rallies and then buy put spreads in equities, in the US especially. That's the risk reward over the course of the next 2 or 3 months probably. Because I keep on thinking about how I would respond to this situation if I was a CFO of some company. I would be trying to lower my earnings expectations to the maximum so I can guarantee to beat in Q3, Q4. That is what I would be doing, and I think it makes perfect sense that CFOs will do that over the course of the next earnings season. Thank you very much indeed, and tweet you on Monday.